Welcome back to another deep dive. We love to unpack some seriously insightful stuff just for you.
Yeah.
And today we're joined by Olivia Smith. She's a true investing whiz.
Oh, stop it. I'm happy to be here, though.
You are, and we are going to be cracking open John C. Bogle's The Little Book of Common Sense Investing.
Classic.
It really is. It's a classic for a reason, and I know you, our listeners, you want to grasp these key investment principles without getting lost in all that jargon.
Yeah.
You know what I'm talking about, right, Olivia?
Absolutely.
We're going to be tackling some fascinating ideas today. I'm excited.
Me too.
Yeah, so we're going to be talking about things like how a family that owns an entire company can still somehow lose out.
Yeah.
The difference between what he calls the hype market and the real deal, and why trying to beat the market might be a losing battle right from the start.
Out the gate.
So, Olivia, this book starts off with a parable. It's about the Gottschalk's family. It's so clever, and it really stuck with me.
Yeah.
Can you refresh our listeners' memory? What was that parable all about?
Absolutely. So the Gottschalk's family parable is about a family who owns 100% of a company.
Okay.
They are entitled to all of the profits, all of them.
So they got the whole pie.
They got the whole pie.
Okay.
But then some family members get a little greedy.
Oh.
And they start thinking they can outsmart each other.
Oh, boy.
And they start rapidly trading shares amongst themselves.
This is not going to end well.
And it gets worse to make things worse. They bring in outside helpers.
Who are these outside helpers?
So these are brokers, advisors.
Gotcha.
And these outside helpers take a cut of every single transaction.
Oh. So even though the company itself might be doing great, the family's actual wealth starts shrinking.
Shrinking because of all the fees and all of the frantic trading.
Exactly.
Yeah.
Okay, so it's not just about picking the right companies, but also understanding how our own behavior can really impact our returns.
Oh, absolutely.
So what's the bigger takeaway here? What do we need to remember?
I think the bigger takeaway is that the Gottschalk's family parable represents all of us.
Right.
Even when we know a company is good, our actions can actually sabotage our gains.
Oh, that's interesting.
So it's a reminder that sometimes the best investing is no investing.
Oh, that's a good point. Yeah, it's like they're taking bites out of their own pie.
They're shrinking the pie.
So now another concept Bogle talks about is the difference between two markets, the real market and the expectations market.
Yes.
And I've heard these terms thrown around, but I'm still a bit fuzzy on the distinction.
Sure.
Can you break it down for us?
Absolutely. I think a good way to think about it is the real market is all about business performance. So the actual dividends and earnings growth that companies achieve.
Okay, so that's the solid foundation, the actual numbers.
The actual number, the fundamentals, right?
Okay.
Now, the expectations market is a bit more slippery.
Yeah.
This is about what investors think a company will do in the future,
Gotcha.
how much they're willing to pay for a stock,
Right.
regardless of the current reality.
So it's almost like a hype premium
It's a hype premium.
on a stock.
Right.
And it's not about how much money the company is actually making,
Yeah.
but how much people think it'll make in the future.
Exactly. And that's where things get risky,
Okay.
because the expectations market is fueled by emotions, fear, and greed.
Yeah, and that can swing pretty wildly.
It can swing wildly, and so if you're constantly trying to buy low and sell high based on those swings,
Yeah.
you're basically speculating.
You're not really investing.
You're not investing, and Bogle says that all the noise and speculation is like a tale told by an idiot full of sound and fury, signifying nothing.
Wow.
He's basically saying, don't get caught up in the hype.
Focus on the fundamentals.
Focus on the fundamentals.
That's interesting because another thing he talks about is this idea of the winner's game versus the loser's game.
Yes.
And it seems kind of counterintuitive, but can you kind of break down what he means by that?
Yeah, so Bogle's idea is that owning the entire stock market through like a broad market index fund is a winner's game.
What?
Because you capture the market's overall return. Trying to beat the market by picking individual stocks or funds is a loser's game, because most investors actually underperform after costs.
So you're not just playing against other investors, you're also playing against professionals with these huge resources.
Huge resources, and still statistically,
Yeah.
the odds are not in your favor.
That's kind of mind-blowing.
Yeah.
So by indexing, I'm removing myself from that competition and increasing my chances of success.
You're increasing your chances of success.
So it's almost like a mindset shift. Instead of stressing about picking individual stocks,
Yes.
I should focus on a simple, low-cost index fund strategy.
That's the Boglehead way.
The Boglehead way.
Yeah.
All right, I'm intrigued, but how do I actually choose the right index funds?
Well, that's where we'll pick up in part 2 of our deep dive. We'll explore the ins and outs of index funds, so be sure to tune in.
Okay, I'm hooked. This is great stuff.
Hmm.
Thanks for joining us, Olivia.
My pleasure.
And for our listener, we'll be back soon to explore even more of Bogle's insights. Until then, happy investing.
Happy investing. Welcome back to our deep dive into the little book of common sense investing.
I'm ready for more Bogle wisdom.
All right.
So last time we left off talking about how choosing the cheapest index funds might be the smartest move.
Yes, because costs, they really can sneak up on you.
Yeah, they really can. So let's say I'm on board with this whole index fund thing.
Okay.
Where do I even begin? There are so many out there.
There are a lot out there, but Bogle does give us some direction.
Okay, I'm all ears.
He actually suggests not picking funds based on their long-term track records.
Wait, seriously,
Those-
but everyone looks at past performance and those star ratings?
I know it seems so counterintuitive, but Bogle looked at data over decades, and he found that very few funds can consistently beat the market.
So all that hype about past performance is basically meaningless.
Pretty much, yeah. He compares it to finding a needle in a haystack.
Okay.
Some funds will always do well in any given period, but it's almost impossible to predict which ones will keep it up.
Okay, so if I can't rely on past performance, how am I supposed to throw a dart at a board?
Not quite. So remember how we talked about costs being a huge factor?
Yeah.
Bogle says that's your most reliable indicator.
Because even if a fund performs well, those high fees are going to eat into my returns, right?
Exactly. They're going to eat into your returns, and it's the one thing you can actually control. He says focus on funds with the lowest expense ratios, trading costs, and no sneaky sales charges.
So simple is best.
It's more like being smart about costs is best.
Okay.
Bogle isn't saying that every cheap fund is a winner,
Gotcha.
but he is saying that expensive funds, they're already starting from behind.
They're starting from behind.
Yeah.
Okay, so costs are king. Got it. But what about making sure I'm not putting all my eggs in one basket, diversification, right?
Yes, exactly. And when it comes to index funds, Bogle is a huge advocate for owning the entire stock market.
Okay, so I shouldn't try to pick and choose specific sectors or industries, just go for a broad market index fund.
Yes, a broad market index fund covers everything.
Okay.
Yeah, because it's incredibly difficult to predict which sectors will do well in the future. Even if you get lucky for a while, things can change very quickly.
You know what? I actually tried stock picking once, thought I was a genius.
Uh-oh.
Let's just say Bogle was right. It did not end well.
It happens to the best of us.
Yeah.
It really does. That's why owning the whole market is like hedging your bets. You're not trying to outsmart anyone. You're just capturing the overall growth.
Okay, this is starting to feel a lot less stressful than my previous attempts at investing.
That's the beauty of Bogle's approach.
So we've talked about cost diversification, owning the whole market.
Yeah.
Anything else I should keep in mind when choosing index funds?
Yes, taxes.
Oh, yeah.
Especially if you're investing in a regular taxable account, not a retirement one.
Right, because even with low-cost funds, if I'm buying and selling all the time, those capital gains taxes can add up.
Exactly. So look for tax-efficient index funds.
Okay.
That means they don't trade very often, and they don't generate a lot of taxable distributions.
Okay. More things to consider. I'm starting to realize there's more to this than I initially thought.
Investing's a journey.
It is.
But Bogle really helps make sense of it all, and guess what his advice applies to bonds, too.
Bonds, I thought those were just for super conservative investors.
Not necessarily. They're an important part of a balanced portfolio.
Okay.
And Bogle believes the same principles apply. Keep it simple, low cost, and diversified.
Okay, so instead of picking individual bonds or trying to time interest rates, he's saying go for a broad bond market index fund.
You know,
Okay.
he points out that even professional bond fund managers struggle to beat the market consistently, especially after those pesky fees.
So it's the loser's game all over again.
Loser's game all over again.
Trying to beat the bond market is just as tough as beating the stock market.
It is. And he stresses that with bonds, costs matter even more
Okay.
because the returns are typically lower than stocks.
Yeah. Makes sense. Those fees would eat up a bigger chunk of my gains.
Exactly. He recommends simple, low-cost bond index funds.
Okay. Are there any specific types he suggests?
He mentions an intermediate-term bond index fund
Okay.
as a good core holding for most people.
Intermediate term. What does that even mean?
So it refers to the maturity dates of the bonds in the fund.
Gotcha.
Intermediate-term bonds usually mature in 5 to 10 years.
Okay. And why is that a good sweet spot?
So it strikes a balance between risk and return. They're less volatile than long-term bonds, but still offer a decent yield.
So not too risky, not too boring. Just
Gotcha. Goldilocks would approve.
Okay.
They can provide a steady income stream and some potential for growth.
Okay. Are there any other bond index funds worth considering?
Bogle also mentions municipal bond index funds.
Those ring a bell. Don't they have something to do with taxes?
Yes, the interest income from municipal bonds is often tax-free,
Okay.
which can be great for people in higher tax brackets.
So you keep more of what you earn. That's awesome.
Yes.
Wow, we've covered a lot of ground today. It's
Yeah.
amazing how much Bogle packs into this little book.
He does, and we're not finished yet.
There's more. I can't wait to hear what else he has to say.
In part 3, we'll explore some of the newer investment options that have popped up since Bogle first wrote this book.
Like those ETFs I've been hearing so much about.
Exactly. We'll see what Bogle thinks of them, and if his core principles still hold up in today's market.
This has been so insightful. Thank you for breaking it all down.
My pleasure. It's
Yeah.
always fun to dive into Bogle's world.
And for our listeners, be sure to join us for part 3, where we'll wrap up our exploration of the Little Book of Common Sense Investing. Until then, happy investing. Welcome back to the Deep Dive. We are wrapping up our exploration of John Bogle's The Little Book of Common Sense Investing with Olivia Smith.
It's been a great journey.
It really has. We've covered so much ground, from the pitfalls of trying to beat the market to the power of those low-cost index funds.
Yeah.
But like you mentioned last time, the investment world is constantly evolving.
Oh, it is for sure.
There's always these new trends and new products popping up.
Always something new.
Yeah, and so in this final part, I'm curious to dig into some of those newer developments and see how Bogle's principles, they still hold up.
Yeah.
So one thing I've been hearing a lot about lately are ETFs.
Exchange-traded funds, yeah, they're definitely having a moment.
They seem to be everywhere.
Everywhere you look.
But to be honest, I'm still a little fuzzy on what exactly they are.
Sure.
How do they differ from those traditional index funds we've been discussing?
Well, in a way, ETFs are like index funds' cooler, younger sibling.
Okay, I like where this is going.
So they're similar in that they track a specific market index, just like the S&P 500.
So they offer that same broad diversification?
Yes, they do. But the key difference is that ETFs are traded on stock exchanges, just like individual company stocks.
So you can buy and sell them throughout the day.
Exactly, which gives you a lot more flexibility. Traditional index funds are usually priced and traded only once a day.
So if I want to react quickly to market movements, ETFs might be a better option.
They could be, but that flexibility comes with a trade-off.
There's always a trade-off.
There's always a trade-off. Because you're buying and selling throughout the day, you might rack up more brokerage commissions if you're trading frequently.
Ah, those pesky costs. They're always lurking around every corner.
They really are. And there's another potential downside to that easy trading.
Let me guess, it tempts people to trade more than they should.
You got it.
Yeah.
It can be so easy to get caught up in the excitement and start trying to time the market, which, as we know, is usually a recipe for disaster.
Remember my stock picking days?
Oh,
Not my proudest moment.
we've all been there.
So while ETFs can be a valuable tool, it's important to use them wisely and not fall into the trap of overtrading.
For sure. For sure.
So what does Bogle think about ETFs? Did he foresee this whole trend?
Well, he wrote the book before ETFs became as popular as they are today, but he does address the potential downsides of overly complex financial products.
Right, because ultimately he's all about simplicity, right?
Exactly. He worries that the explosion of ETFs, especially those focused on very specific parts of the market, has moved away from the core principles of diversification and owning the entire market.
So instead of buying a broad market ETF, people are using them to bet on specific sectors or industries.
That's right. And as we've discussed, that kind of speculation is rarely a winning strategy.
It's the loser's game in a shiny new package.
There you go. That's a great way to put it.
Yeah, Bogle's advice is clear. Stick to the fundamentals.
Yeah.
Don't get distracted by the allure of complexity or the promise of, easy riches.
For sure.
Right. And ETFs aren't the only new thing on the scene. He also had some strong opinions about hedge funds, which seem to be shrouded in this mystery and exclusivity.
Yes.
So what are his main concerns?
Well, first off, he points out that they're incredibly expensive.
Okay.
They charge these high management fees and often take a cut of any profits.
Are those costs ever going to go away?
I don't think so.
And Bogle argues that those exorbitant fees make it extremely difficult for hedge funds to consistently outperform the market, especially after you factor in the risks involved.
It's a tough game.
So even if a hedge fund has a good year, a big chunk of those gains go straight to the fund managers.
Exactly. And remember, those impressive returns often come with higher risks, which most individual investors aren't equipped to handle.
But aren't there some hedge funds that have like consistently high returns? Is Bogle being too dismissive?
He acknowledges that there might be a few exceptions, but for the vast majority of people,
Yeah.
he believes the risks far outweigh the potential
It's
rewards.
like he's saying, don't believe the hype.
Exactly. Don't believe the hype.
Right.
He believes that for most people, sticking with a simple, low-cost index fund strategy is a much more sensible approach.
So ETFs might be okay if used carefully, but hedge funds are a definite no-go.
That's a pretty accurate summary of Bogle's view.
You know, it's really refreshing to hear such a straightforward and honest perspective on these often hyped investment vehicles.
Absolutely.
It's easy to get swept up in all that marketing and the allure of big returns, but Bogle reminds us to always look beyond the surface.
Right.
Focus on those fundamentals.
Right.
So what's the big takeaway here? Are there any other words of wisdom that Bogle leaves us with as we kind of wrap up this book?
Well, I think a big takeaway is that the financial industry can be incredibly complex,
It can be.
but investing doesn't have to be.
It seems like there's always new products and strategies emerging. It's kind of overwhelming.
It is. There's a lot of noise.
Yeah.
And Bogle believes that all of this complexity often benefits the financial institutions more than it benefits individual investors.
Right, because they're the ones collecting all the fees and commissions.
Right.
Yeah. And he reminds us that the simplest approach, owning a diversified portfolio of low-cost index funds, is often the most effective.
Often the most effective.
Yeah, it's about tuning out all the noise, cutting through the jargon, and staying focused on those core principles of common sense investing.
Exactly. And that message is timeless. It's just as relevant today in today's market as it was when Bogle first wrote the book.
Well, Olivia, this has been an incredible deep dive into the little book of common sense investing.
It has. It's been a pleasure. Bogle's insights are always thought-provoking.
Yeah, and I feel like I have a whole new perspective on investing for our listener. I hope you've gained some valuable knowledge and feel empowered to make smart decisions.
Absolutely.
Remember, Bogle's principles of simplicity, low-cost diversification, and discipline can be applied no matter what the market throws at us.
That's a great point.
But always do your own research before making any investment choices.
Absolutely. Don't blindly follow anyone's advice, even Bogle's.
Right.
Think for yourself and invest in what aligns with your goals and your values.
Couldn't have said it better myself. Thanks for joining us on this deep dive, everyone. We'll see you next time for another insightful exploration.
Until then, happy investing.